Nice to have you with us this morning, and we lead this hour with the latest on Canada's economy, which appears to be running out of steam. We now have an early look at how the first quarter played out. New data this morning from Stats Canada suggesting GDP was flat in March. Meanwhile, in February, growth of 0.2% fell short of economist expectations, and the expansion in January was revised lower, pointing to overall first quarter growth of around 2.5%, which would be slightly below the Bank of Canada's own forecasts. And while the numbers don't suggest a sharp downturn is on the horizon, this data, coupled with signs of easing inflation pressures, could build the case for an interest rate cut by June. Ahead of these numbers, most Bay Street economists were already expecting a 25 basis point cut at that upcoming June meeting, kicking off an easing cycle at a time when interest rate expectations in the U.S. keep getting pushed back. Let's get some more perspective now from Sadiq Adatia, he's Chief Investment Officer at BMO Asset Management. Nice to see you.
Thanks for having me.
What's your reaction to the GDP numbers today?
Yeah, not surprising. I mean, we've been underweight Canadian equities now for probably most of this year, if not even part of last year. We just see a slowing economy, not necessarily a disastrous one, but definitely a slowing economy. We're seeing inflation come down. We're seeing a little bit weakness on the job front as well. So overall, I do think that, as you alluded to, the Bank of Canada probably will be cutting rates, I think, in June. Every sign points to it. And the only reason they wouldn't do it is if they're worried about where the Fed is going to be at by the end of the year and not go too far ahead of that. But even I think today they should be moving forward.
What specifically, with respect to the Canadian economy, worries you the most?
Yeah, I think the GDP numbers highlight that it's sluggish growth at best. We're also seeing, again, pressure on the consumer. I think that's another part that really worries me, and I think it's only going to get worse in the coming months with mortgage renewals. But you're seeing consumers, tighten up a little bit of their belts. I think they're being a little bit more cautious how they spend their money. If we have more job losses potentially occurring down the road, that will even cause even more of a detrimental impact on consumer demand. So that together gets me a little bit more worried about where the Canadian economy will be in 6 to 12 months from now.
You talked about, by comparison, the U.S. economy. A lot of people have highlighted the resilience of that consumer. Is this interest rate dynamic and the differences of the mortgage market there, is that one of the considerations?
Yeah, that's exactly it. I mean, consumers in the U.S. are in much better shape. Their mortgage situation is different than Canadian. How much you can amortize that across the board. So they're in a much different position. Therefore, they can still spend on the economy. The top 20% in the U.S. still have excess cash as well. So they're still spending quite a bit. It's the lower end that is tightening up a little bit, but Canada's already past that level. So I would say that Canada's 6 to 12 months ahead of where the U.S. might be. That means that Canada has to start to do a little bit something today, and cutting interest rates would definitely help the consumer.
I spoke to an economist yesterday who described Tiff Macklem, the Bank of Canada governor, as a dove at heart, that in many ways seeing more signs that would open the door towards cutting rates is something that he would likely embrace. Any thoughts on that? Yeah,
I think so. Though I must say that maybe about 12 months ago, he was very much hawkish and wouldn't give in to any sign of being dovish. I think more recently, he has definitely been showing signs of being a little bit more dovish. So if it's not June, it's there shortly thereafter. But I do think we're getting that rate cut.
Now, some past signaling from the Bank of Canada complicated matters. I am going back about a year or so, but I do wonder if you start to see more of a disconnect between Canada and the U.S. on rates. How do you think it plays out? Are they in it? Because I guess the significance of if they were to cut in June is, I think a lot of people would view that as an official pivot point. We're done with raising interest rates, we're done with holding interest rates, and now we've moved into a period where interest rates are going to come down. How challenging will it be to go more than, I don't know, a couple 25 basis point cuts if the U.S. isn't even cutting interest rates this year?
Yeah, it's going to be interesting for sure. It's not an easy situation. I think what you will see is Canada will start cutting 25 basis points. They'll probably do another one thereafter. But they don't have to go every single quarter with the rate cut. And so if they've done a couple, they can wait and see where the Federal Reserve is at that point in time to decide, where they want to go. But I think they've highlighted, and even Europe's done the same thing, that, the economy is not the U.S. economy. And we don't need to do what the U.S. is necessarily doing. I think they're all aware of what U.S. is going to do. But I think if Canada doesn't start cutting rates, they're going to fall well behind the U.S. And you can see by today's Canadian dollar, like the impact that for sure Canada should be cutting rates and U.S. is not. It's having an impact on the Canadian dollar as well.
Yeah, maybe we should show our audience what's happening with the Loonie, which really has struggled to make any notable move above 74 cents. And here we are, I believe, below 73 cents right now. You saw some of that immediate impact in the Canadian currency. How does this factor into the Bank of Canada's thinking, do you think?
Yeah, I don't, I think in some sense they still are okay with a weaker Canadian dollar just for the economy standpoint. But I think at some point they're going to be careful about that too as well. I don't think they want to see the Canadian dollar go under 70 cents as an example. So I think anywhere in the low 70s, I think they're still fine. Once you break in that mental threshold of the 60s, I think that's when they get a little bit more cautious.
I do want to talk more sector strategy after our break, but you highlighted that you'd been, on average, underweight the Canadian stock market, in part because of the economic realities. Is that correct?
Yeah, that's right. I mean, knock on wood, I think we've had a really good call in the last year or so. So we were underweight Canadian equities because of what's going on. We saw it being lagging behind the U.S. economy. And part of it is also the strength of the U.S. economy is why we want to be underweight Canada. And the weakness of the Canadian dollar also helps, U.S. allocations.